Hey everyone, Iggy here from the Investing Iguana. DBS just hit $54 per share. Market cap sale past $150 billion. Everyone's celebrating. But here's the question, keeping Singapore investors up at night. Is this banking giant still worth buying at these all-time highs, or are we staring at a classic bull market trap? Before we dive in, quick context. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I bring that professional lens to every analysis, especially when it comes to Singapore's biggest banking champion. This video is adapted from my latest in-depth Substack deep dive, where I break down the full numbers, tables, and frameworks. Today, we're going to walk through 6 critical areas. First, how DBS became Southeast Asia's unstoppable banking titan. Second, the record-breaking financial performance driving this rally. Third, the wealth management goldmine fueling growth. Fourth, how DBS is navigating interest rate headwinds. Fifth, the valuation reality check every investor needs. And sixth, my personal verdict on whether quality justifies this price. Let's jump in. Picture this. You're a Singapore investor sitting on DBS shares. You bought at $30, maybe $40. Now it's $54. You've made serious money. But your colleague just asked you the most dangerous question in investing. Should I buy DBS now? And suddenly, you're not so sure anymore. That's the dilemma facing every Singapore investor right now. DBS has climbed 25% year to date. It's nearly double the size of OCBC in market cap. It became the first Singapore-listed company to cross $100 billion in value. This isn't hype. This is sustained operational excellence that the market keeps rewarding with premium valuations. In my Substack article, I included a detailed comparison table showing DBS at $150 billion market cap versus OCBC at $75 billion and UOB at $61 billion. All 3 banks are up around 20 to 25% this year. But DBS has pulled so far ahead that it's almost in a league of its own. The market is telling us something. The question is whether we should listen. Now let's talk about the results driving this confidence. Third quarter 2024 was a monster. DBS reported $303 billion in quarterly net profit. That's 15% higher than last year. It's the first time the bank crossed the $3 billion threshold in a single quarter. Total income jumped 11% to $575 billion. Fee income hit records. Trading revenue hit the highest level in 10 quarters. The numbers aren't just good. They're exceptional. Return on equity sits at 18.8% for the 9-month period. That means for every dollar of shareholder capital, DBS generates nearly 19 cents in profit annually. Most banks struggle to hit 15%. DBS makes it look easy. I created a performance breakdown table in the article showing net profit, total income, cost-income ratio, and return on equity all in one view. The key takeaway is this. DBS isn't just riding interest rate tailwinds. It's executing across multiple business lines simultaneously. That diversification matters when markets get choppy. Here's where the story gets really interesting. Wealth management. This is the secret weapon DBS has been building for years, and it's finally paying off in spectacular fashion. Wealth management fees surged 45% in 2024 to reach $2.18 billion. Assets under management hit a record $396 billion. Why does this matter? Because wealth management generates stable, recurring fee income. Unlike lending, where you're dependent on interest rate spreads and credit quality, wealth management earns fees on assets. When rich clients park money with DBS for investment products, insurance, and portfolio management, the bank collects fees whether markets go up or down. Singapore's emergence as a regional wealth hub plays right into DBS's hands. High net worth individuals from across Asia are moving money into Singapore for stability and sophistication. DBS has the digital infrastructure, the regional footprint, and the brand to capture that flow. In the article, I included a revenue mix evolution table showing how DBS has shifted from 65% net interest income in 2023 down to 62% in 2024, while wealth management jumped from 12% to 18%. This isn't a small change. It's a fundamental business model transformation that justifies the premium valuation investors are paying. For all the full charts, checklists, and the complete written playbook, grab this post on Substack. Link is in the description. Now we hit the tricky part. Interest rates. Every bank faces the same challenge right now. Central banks are cutting rates. The US Federal Reserve is cutting. Eventually, other central banks follow. When rates fall, net interest margins get squeezed. That's banking 101. DBS isn't immune to this pressure. Net interest margin has already shown signs of compression. But here's what separates great banks from average ones. DBS management saw this coming. They've been proactively hedging their balance sheet to reduce rate sensitivity. They've maintained a stable commercial book margin of 2.83% in Q3 2024, even as cuts began. The trade-off works like this. Lower rates squeeze margins but stimulate loan demand. If DBS can grow its loan book by 5 to 7% while margins compress slightly, total net interest income might stay flat or even grow. Add in the booming wealth management fees, and suddenly the rate cuts become manageable instead of catastrophic. I built an interest rate impact analysis table in the Substack article showing 3 scenarios: current high rates, rate cuts beginning, and deep cuts. The punchline is that DBS appears well positioned across all 3. The diversified business model and proactive management give them flexibility most banks don't have. So here's the million-dollar question. Is DBS worth the premium price tag? Right now, DBS trades at 1.88 times book value. OCBC trades at 1.27 times. UOB trades at 130 times. You're paying 50% more for DBS compared to its peers on a book value basis. Forward, price to earnings sits around 11.94 times. That's higher than OCBC at 1040 times and UOB at 1017 times. But here's the counter argument. DBS generates 18.8% return on equity, while OCBC delivers 14.1% and UOB delivers 15.2%. You get what you pay for. The 5-year track record backs this up. DBS has delivered 166% total returns over 5 years. That's not just market beating. That's wealth compounding performance that few stocks in Singapore can match. The bank has earned its premium through consistent execution, superior profitability, and shareholder-friendly capital allocation. In my comparative valuation metrics table on Substack, I break down PE ratios, price to book, dividend yields, and return on equity across all 3 banks. The visual makes it crystal clear why DBS commands premium valuations. Quality shows up in the numbers. Let's talk about what DBS is doing with all that profit. Capital allocation. This is where management proves whether they care about shareholders or empire building. DBS announced a new $3 billion share buyback program in Q3. They're paying quarterly dividends of sterling 54 per share. Year-to-date dividends total $1.62 per share. This aggressive capital return strategy sends a powerful message. Management believes the business will keep generating excess capital. They're confident enough to return billions to shareholders while maintaining a strong CET1 ratio of 17.2%, well above regulatory minimums. Compare this to banks that hoard capital or make questionable acquisitions. DBS is saying, we're generating more cash than we need for growth. We're returning it to you through dividends and buybacks. That's shareholder-friendly behavior that justifies paying a premium valuation. So here's my personal take, grounded in years of analyzing Singapore banks and regional markets. DBS represents the rare combination of market leadership, operational excellence, and strategic positioning. The transformation toward wealth management, the digital capabilities, the regional expansion, these aren't short-term wins. They're structural advantages that compound over decades. Singapore's role as Asia's wealth hub is a multi-decade trend. Rising affluence across Southeast Asia is a multi-decade trend. DBS sits at the intersection of both. That's powerful positioning few banks can replicate. But valuations matter. At 1.88 times book value and nearly 12 times forward earnings, you're paying for perfection. Any stumble triggers volatility, unexpected credit losses, prolonged margin compression. Execution mistakes. These risks become magnified when valuations run hot. In the article, I created an investment decision framework table breaking down recommendations by investor profile. Long-term, quality-focused investors should buy on weakness because structural advantages justify the premium. Value-conscious investors might consider OCBC or UOB for better entry valuations. Dividend income seekers can hold current positions. Growth seekers can accumulate selectively because the wealth management story stays intact. For existing shareholders, I'd hold. DBS continues executing at the highest level. The strategic mode is real. The capital returns are generous. Unless you need the cash or want to rebalance, there's no compelling reason to sell a winner. For new investors, patience pays. DBS offers unmatched quality in Singapore banking, but current prices reflect much of that quality. Consider building positions gradually. Wait for market volatility to create temporary discounts. Don't chase record highs hoping for quick gains. The challenge for Singapore investors is this: can you pay up for quality and still sleep well at night? Or do you need the comfort of cheaper valuations even if the business is inferior? That's the personal decision framework every investor must resolve. So here's the bottom line. DBS hit all-time highs because it earned them. Record profits, wealth management transformation, shareholder-friendly capital allocation. This isn't luck, it's execution. But record highs also mean limited margin of safety. Quality commands its price, and right now, that price is steep. If you found this analysis valuable, smash that like button. Share this video with fellow Singapore investors trying to figure out DBS. Subscribe if you want more deep dives on SGX stocks, REITs, and regional market trends. And seriously, check out the full Substack article with all the tables, frameworks, and analysis. Link is in the description. Next up, watch my video breaking down whether OCBC or UOB might offer better value for investors worried about DBS's premium pricing. That comparison will give you the full Singapore banking picture. Until next time, keep investing smart, stay disciplined, and remember, quality matters, but so does price. See you in the next one.